Hello and welcome to this video. In this video, we are going to do a question from A-Level Accounting Paper 3, May-June 2023, variant 31 and 33, question 2. The question states that the directors of ZPLC provided the following information. For the year ended 31st December 2022, revenues, all credit sale, $825,000, purchases, all on credit, $405,000, non-current assets turnover 1.6 times, interim dividend paid per share $0.30, final dividend proposed and paid $0.15, gross profit 48%, dividend yield 4%, price earning ratio 18. At the 31st December 2022, inventory is $44,000, trade receivables are $76,400, trade payables are $32,900, cash at bank is $81,000, 6% debentures which are redeemed on 2026 and it's $100,000, ordinary share capital of $1 share each of $300,000 and share premium is $30,000. In the A-bit of the question, we are asked to state two comparisons which a business may make by using ratios to assess its performance. The two comparisons which the business can use is trend analysis. In trend analysis, what we do is we take the historic data or the past data and compare it with the present data so that we can predict the future trend. And in interfirm comparison, we compare two competitors, that is, we compare our firm with our competitors' firm to find that how they are profitable or where they have strength and where are our weaknesses so that we can grow. Like the comparison between Apple and Android, we can compare the ratios to find how Apple is growing or how Android is growing and what are the strength and weaknesses of the firm so that they can grow. Or there is another comparison which is the industrial average, where we find the average for all the industries. Like for the mobile industry, we find the average ratios for all the mobile industry and compare our firm with the average of the industry. In the B bit of the question, in the first bit, we are asked to find the net assets at 31st December 2022. You see, net assets will be exactly same as the equity in the firms where we do not have intangible assets like goodwill or other non-cash items. As the case of this business in which we are talking about ZPLC, we don't have any intangible assets. However, if the firm do have intangible assets, then what we do is for net assets, we take the assets and liabilities and we subtract the intangible assets, whereas we don't do this, that is, we don't subtract the intangible assets when we calculate the equity. So as here net assets and equity are same, so we are going to take the accounting equation which states that assets equal to equity plus liability. So equity or net assets, which we are going to term for this question, will be equal to assets minus liabilities. Therefore, our net assets will be the total non-current assets plus the current assets which make up the total assets. And from there, we are going to subtract the total current liabilities and total non-current liabilities which will make up the total liabilities. So here in the question, we don't have the total non-current assets. So for this, they have given us the non-current asset turnover ratio. So we are going to take this and apply the formula, that is non-current assets turnover is equals to net revenue divided by total net book value of non-current assets. And with this, we will find the total value of non-current assets. Then we will proceed and find the net assets. The value of non-current assets turnover is given as 1.6 times and our revenue is $825,000 divided by the total net book value of non-current assets. If we take this to the other side, then we will have $825,000 which is our revenue and divided by the 1.6 times which is our non-current assets turnover ratio. So we will get the value as $515,625 as total net book value of non-current assets. Now, as we have all the information, we will proceed and find the net assets at 31st December 2022. We'll start with the non-current assets, which we have calculated as $515,625, and we will take the current assets, which was given as, for inventory it was $44,000, trade receivable was $76,400, cash at bank as $81,000. So when we add this all together, we get the total current assets as $201,400. And now we will take the non-current assets. To this we add the current assets. We will get the total assets as $717,025. From here we have to subtract the total liabilities. So we'll start with the current liabilities, in which we have trade payables as $32,900 and the non-current liabilities, in which we have debentures as $100,000. So when we add this two, it will be $132,900. This have to be subtracted from the total assets to get the net assets. So $717,025. From there we subtract $132,900. We will get the total net assets as $584,125. In the second bit of the question, we are asked to find the retained earning at 31st December 2022, which is the closing retained earning. And how do we get it? You see, we take the opening retained earning. To this we add the profit for the year, and from there we pay the dividends. Hence we subtract the dividends, and we subtract any transfer to the other reserves, like the transfer to general reserve. We don't have any general reserve here, so it will be the opening retained earning plus the profit for the year minus the dividend. However, information related to the opening retained earning is also not given. So what we have to do is, now we'll take the other formula, that is equity is equals to share capital plus reserves plus the closing retained earning. Here the reserves which we have will be the share premium reserve or the revaluation reserve. We don't have the revaluation reserve here, so it will be just the share premium reserve. And to get the closing retained earning, we'll take this to the other side. Here it is in addition, there it will be in subtraction. So closing retained earning will be equal to equity minus share capital minus the reserves, that is the share premium reserve. So I told you in the first bit that here equity and net assets are equal, as we don't have intangible assets. So we'll take the value from the bit 1, where it was $584,125, and the ordinary share capital, which was given as $300,000, will be subtracted. The share premium reserve, which was given as $30,000, will be subtracted. Now the retained earning, that is the closing retained earning, will be $254,125. In the third bit of the question, we are asked to find the retained earning at 1st January 2022, which will be the opening retained earning. Now, as we know the closing retained earning, we'll take the formula which I have told here, that is the closing retained earning is equals to opening retained earning plus the profit for the year minus the dividend paid. So for this, what we can do is, we can take this, that is the profit for the year, to the other side. Here it is in addition, there it will be in subtraction, and the dividend paid also to the other side. Here it is in subtraction, there it will be in addition. So our opening retained earning will be equal to closing retained earning minus the profit for the year plus the dividend paid. So with this formula, we can calculate the opening retained earning. However, we don't have profit for the year also given. So what we have to do is, we will first calculate the profit for the year, then we will calculate the opening retained earning. You see, the other information which was given was the earning per share ratio and the dividend yield ratio. However, we need to know the earning per share to find the profit for the year, because the formula for earning per share is equals to profit for the year divided by the number of ordinary shares issued. So for this, we are going to use the other information which is given, and then we will find the earning per share, then we will find the profit for the year. So the information which we have for this is, earning per share is equals to profit for the year divided by the number of issued ordinary shares. It was given the ordinary share capital was $300,000 and each share has a face value of $1. So $300,000 divided by 1 will be 300,000 ordinary shares which have been issued. So profit for the year will be equal to earning per share times 300,000. Now to get the earning per share, we are going to use the price earning ratio, where we have the market price per share divided by the earning per share. So if we take the earning per share to the other side, it will be market price per share divided by the price earning. Now we don't know the market price per share as well. So for this, what we are going to do is we are going to use the dividend yield ratio, where we have the dividend per share divided by the market price per share. Now what we can do is we can take market price to the other side and bring down the dividend yield ratio. So now market price per share will be equal to dividend per share divided by dividend yield, and dividend per share will be both the dividends, that is the dividend paid and the dividend proposed. So when we add this two, it will be 45 cents, and we will divide it with 4%. We will get the value for market per share as $11.25. Now we have this, so we can find the price earning per share, because it is market price per share divided by price earning. We know the price earning, which was given as 18 times, so it will be earning per share is equals to $11.25 divided by 18, which will be equal to 0.625. Now we know the earning per share, and we know that the profit for the year is equal to earning per share times 300,000 units of shares which was issued. So it will be profit for the year equal to 0.625 times 300,000 shares, which will be equal to $187,500. Now as we have all the information, we will find the opening retained earning using the formula which I stated previously, that is opening retained earning is equals to closing retained earning minus the profit for the year plus the dividend paid. So we'll start with the retained earning at 31st December 2022, which will be the closing year retained earning at the end of the year, and we have calculated this in the bit 2 of the question as $254,125. The profit for the year, which we have calculated in our working notes as $187,500, and this have to be subtracted based on our formula. And the dividend paid was 300,000 shares were issued, and for each share it was 30 cents. So 300,000 times 30 cents will get it as $90,000, and this have to be added. So when we add and subtract, we get the retained earning at the 1st January 2022, which will be the opening retained earning, because this is the beginning of the year. So it will be $156,625. In the CBIT, we are asked to calculate the following at 31st December 2022. The first thing which we have to calculate here is the working capital cycle around each component up to the next whole day. So we'll start with the working notes, where the working capital cycle in days is equals to the trade receivable turnover in days plus the inventory turnover in days minus the trade payable turnover in days. So for trade receivable turnover, we have a formula which is equal to trade receivable divided by the credit sales times 365 days. So here the trade receivable are given as $76,400, and we have the sales which are all on credit, so it is $825,000 times 365 days. We will get the value as 34 days. Next we have inventory turnover in days, which is equals to average inventory divided by cost of sales into 365 days. We don't know the cost of sales, but the information which is given is gross profit is equals to 48%. You see, gross profit is equals to sales revenue minus cost of sales. So if you want to find the cost of sales and we take it to the other side, it will be cost of sales is equals to sales revenue minus the gross profit. So if the sales revenue is 100%, because sales revenue is divided into two parts, that is cost of sales and gross profit margin. So here if it is 100%, so cost of sales will be equal to 100 minus 48%, which will be 52%. Therefore our cost of sales will be 52% of what? Of our sales revenue, which is $825,000 times 52, which will be $429,000. Now we have to find the average inventory. For average inventory, we don't have the opening inventory, we have the closing inventory, because it will be opening inventory plus the closing inventory divided by 2. So we are first going to find the opening inventory, then we will find the average inventory. For cost of sales, we have a formula which is equals to opening inventory plus purchases minus closing inventory. So what we are going to do is we are going to take the purchases to the other side. Here it is in addition, there it will be in subtraction, and the closing inventory to the other side. Here it is in subtraction and there it will be in addition. So our opening inventory will be equal to cost of sales plus the closing inventory minus the purchases. So cost of sales which we have calculated is $429,000. Purchases and closing inventory are given. So here the closing inventory which was given was $44,000 and the purchases which was given was $405,000. So we'll get the opening inventory as $68,000. Now the average inventory will be 68,000 plus 44,000 divided by 2, which will be $56,000. Now we can find the inventory turnover ratio, which is equals to the average inventory, which is $56,000 divided by the cost of sales, which is $429,000 times 365 days. We'll get the value as 48 days. Now we have trade payable turnover in days. We have trade payable divided by the credit purchases times 365 days. Trade payables were given as $32,900 and the credit purchases, all the purchases were on credit. So we have $405,000 which was given as the purchases times 365 days. We'll get the value as 30 days. Now we'll find the working capital cycle where we have the trade receivable turnover which we have calculated in our working notes as 34 days. To this we add the inventory turnover which is 48 days, which we have again calculated in our working notes. From there we will subtract the trade payable turnover, that is minus 30 days, that is 34 days plus 48 days minus 30 days. We will get the working capital cycle as 52 days. Next we have to find the gearing ratio to two decimal places. Gearing ratio is equals to fixed cost capital divided by total capital times 100. In fixed cost capital we have the non-current liabilities, and in the total capital we take the issued ordinary shares plus all the reserves plus non-current liabilities times 100. Now non-current liabilities, debentures are given which is $100,000. So we have taken, this is the only non-current liability, so we have taken this. Then the issued ordinary share were for $300,000. Then in reserves we have the share premium reserve which was $30,000 and the retained earning which we calculated as $254,125 plus the non-current liabilities which are our debentures $100,000, and then we multiply this with 100. So we'll get this value as 14.62% for the gearing ratio. Furthermore, additional information is provided which states that BPLC, a major competitor, has a working capital cycle which is 5 days shorter than that of ZPLC. In the debate of the question, we are asked to advise the directors of ZPLC whether or not they should be concerned about the company's working capital cycle, and we have to justify our answer. I would advise the directors of ZPLC to be concerned about the working capital cycle because it's too long. It is 52 days, which shows that ZPLC is taking 52 days to convert the working capital to cash. Moreover, the inventory held is also for a long period, as the inventory turnover ratio is 42 days, which shows that the inventory is converted into sales in 42 days. Furthermore, the trade receivable period is 34 days and all the sales are made on credit basis, which means that they may face a liquidity crisis as the trade payable turnover ratio is just 30 days and they have to pay this amount in 30 days, and if they are not paying this, there may be issues with the supplier, and the working capital is taking 52 days to convert into cash. The inventory to convert into sales, it is taking 42 days, and all the sales are on credit basis. They are receiving from the debtors in 34 days and they have to pay within 30 days. So naturally this may lead to a lot of liquidity crisis as well as insolvency, or it may also lead to business failure. Hence I suggest ZPLC to reduce the inventory turnover ratio or to reduce the trade receivable period so that they can have a short working capital cycle and hence they may not face any liquidity issues. With this, we have completed this question. Thanks for watching my videos. Have a peaceful and blessed life.